What's up, everyone? I'm William, and welcome back to the channel where we cut through the noise and bring you real opportunities in the stock market. If you're new here, this is where we analyze undervalued stocks with serious potential, backed by solid research and actual data. Today, we're talking about something special, two energy penny stocks trading under $5 that could be game changers for your portfolio in 2025. So hit that subscribe button, drop a like, and let's get straight into it. What if I told you that two energy companies trading under $5 could potentially transform your portfolio this year? While most investors are chasing overpriced tech stocks, a select few are quietly accumulating positions in overlooked energy plays that are showing remarkable financial improvements and strategic partnerships. Today, we're diving deep into two penny stocks in the energy sector that have caught the attention of institutional investors and could be positioning themselves for significant upside. The energy landscape is undergoing a massive transformation. We're witnessing a convergence of innovation in battery technology, strategic drilling operations, and partnerships with industry giants that could redefine how we think about energy investments. The beautiful thing about penny stocks in this space is the asymmetric risk-reward profile. When you're buying a stock under $5 with real revenue, improving fundamentals, and major industry partnerships, your downside is limited while your upside could be exponential. But here's what separates winning penny stock investments from the disasters: due diligence on financials, understanding the business model, and identifying real catalysts. Energy demand is surging globally. Electric vehicle adoption is accelerating faster than infrastructure can keep up. Traditional energy sources are experiencing supply constraints while demand remains robust. This creates opportunity at both ends of the spectrum, and the two companies we're discussing today represent both the future of energy storage and the present reality of energy production. These aren't speculative moonshots with no revenue. These are real companies with real operations, reporting actual financial results and making meaningful progress in their respective sectors. Now, investors looking at penny stocks need to shift their mindset. This isn't about finding the next meme stock that will triple overnight. This is about identifying undervalued companies with legitimate growth trajectories that the broader market hasn't fully recognized yet. The companies we're covering today have market capitalizations that don't reflect their strategic positioning or their potential impact on their industries. One is pioneering next-generation battery technology with partnerships that read like a who's who of the automotive industry. The other is an oil and gas producer that has been quietly executing on an acquisition strategy while improving operational efficiency and generating actual cash flow. Let's talk about our first company. And this is where things get really interesting for anyone paying attention to the electric vehicle revolution. Solid Power Incorporated is trading well under $5, and this company is working on what many consider the holy grail of battery technology: solid-state batteries. Current lithium-ion batteries have limitations. They can catch fire, they degrade over time, and they have energy density constraints. Solid-state batteries promise to solve these problems by replacing the liquid electrolyte with a solid material, making them safer, more energy-dense, and longer-lasting. But here's what makes Solid Power different. They have actual partnerships with major automotive manufacturers. We're talking about BMW and Ford. These aren't just memorandums of understanding. These are joint development agreements where these automotive giants are actively working with Solid Power to integrate their technology into future vehicle platforms. BMW has been particularly vocal about their solid-state battery ambitions, targeting implementation later this decade. Ford continues to invest heavily in electrification and sees solid-state technology as a key differentiator. Now let's dig into the financials. Looking at their recent quarterly reports, Solid Power showed revenue of approximately $1.3 million, primarily from government contracts and development agreements. They're not generating significant revenue yet, but they're not burning through cash recklessly. The company ended their recent quarter with approximately $287 million in cash and marketable securities. That's a substantial cash position for a company with a market cap hovering around $400 million. This runway gives them years to execute without needing to raise dilutive capital. The burn rate has been running approximately $20 to $30 million per quarter. Management has been clear about their milestones, delivering a sample cells to automotive partners, scaling up their pilot production line, and ultimately licensing their technology rather than becoming a cell manufacturer themselves. Solid Power isn't trying to compete with massive battery manufacturers. Instead, they're positioning themselves as a technology licensor, which could provide higher margins and less capital intensity if successful. The collaboration with BMW includes multi-year testing and feedback for automotive integration. Ford's relationship includes both financial investment and technical collaboration. SK Innovation, one of the world's largest battery manufacturers, is also a partner and investor. This partnership brings manufacturing expertise and scale that Solid Power lacks. The strategy is elegant: develop the technology, prove it works through partnerships with BMW and Ford, then license it to manufacturers like SK Innovation for mass production. Risk factors: absolutely. Solid-state battery technology has been perpetually 5 years away for over a decade. Technical challenges remain in achieving the energy density, cycle life, and charging rates needed for automotive applications at scale. The company faces intense competition from other developers like QuantumScape. And as a pre-revenue company, Solid Power's valuation is entirely based on future potential, making it vulnerable to market sentiment shifts and development delays. However, the recent technical progress is encouraging, and major automakers continue to engage deeply, suggesting the technology is maturing. Now, let's shift gears entirely and talk about our second company, which operates in a completely different part of the energy equation. Ring Energy Incorporated is an oil and gas exploration and production company focused on conventional plays in Texas and Kansas. And this company has been executing a transformation that deserves more attention. Ring Energy trades under $5 and has been on an acquisition spree fundamentally changing their operations. They've completed multiple strategic acquisitions that have more than tripled their production. The most significant move was acquiring Stronghold Energy, which added substantial assets in the Central Basin platform of West Texas. This added high-quality, low-decline conventional production that generates strong cash flow at current oil prices. Let's talk numbers. In their most recent quarterly report, Ring Energy reported production of approximately 15,000 barrels of oil equivalent per day. Revenue came in at approximately $93 million for the quarter, with adjusted EBITDA of around $51 million. That's an EBITDA margin of over 50%, which is impressive for a small-cap producer. The company has been generating free cash flow, meaning they're producing more cash than they're spending on capital expenditures. Operational efficiency has been improving quarter over quarter. Lease operating expenses per barrel have been trending downward as they integrate acquisitions and optimize operations. In their latest quarter, LE came in at approximately $13 per BOE, which is competitive for conventional production. With oil prices in the $70 to $80 range, the company is generating strong margins on their production. Ring Energy's balance sheet has been a focus area for management. Total debt stands at approximately $320 million, but the company has been using free cash flow to pay down debt consistently. Their debt-to-EBITDA ratio has improved to approximately 1.6 times, which is manageable. Management prioritizes capital discipline, with expenditure budgets focused on high-return projects rather than aggressive production growth. The geographic focus on Texas and Kansas provides several advantages. The Central Basin platform and Delaware Basin are mature, well-understood plays with extensive infrastructure. This means lower finding and development costs. The conventional nature of their assets also means lower decline rates than horizontal shale wells, providing more predictable production profiles. Additionally, proximity to midstream infrastructure means better pricing realizations and lower transportation costs. What's the investment thesis? Ring Energy is a cash-flowing oil producer trading at a significant discount to larger peers on metrics like EV to EBITDA. The company is using cash flow to strengthen the balance sheet while maintaining production. At current oil prices, they generate substantial free cash flow that could support debt reduction, potential dividends, or additional acquisitions. Of course, risks exist. Ring Energy's fortunes are tied directly to commodity prices, and oil volatility can significantly impact profitability. A sustained decline below $60 per barrel would compress margins. There's execution risk related to integrating acquisitions and maintaining production. The oil and gas sector faces long-term headwinds from the energy transition, and as a small-cap producer, Ring Energy has less financial flexibility than larger competitors if conditions deteriorate. However, their asset quality, improving operational metrics, and strong cash flow generation make it an interesting value play. Before we wrap up, let me quickly walk you through this infographic that summarizes everything we've covered today. On your screen, you'll see our comparison chart. Solid Power, trading under $5, is your growth play in battery technology with BMW and Ford partnerships, $287 million in cash, but pre-revenue status. It's high risk, high reward with a 3 to 5 year time horizon. Ring Energy, also under $5, is your value play in oil production with $93 million quarterly revenue, $51 million EBITDA, and positive free cash flow. It's moderate risk with commodity exposure and a 1 to 2 year time horizon. My recommendation, if you're aggressive and believe in the EV revolution, allocate a small position to Solid Power. If you want cash flow and value with oil price exposure, Ring Energy fits that profile. Or consider both for diversified energy exposure at different risk levels. So there you have it, folks. 2 energy penny stocks under $5 representing completely different opportunities. Solid Power is your speculative bet on next-generation battery technology with major automotive partnerships. Ring Energy is your value play on a cash-flowing oil producer improving operations and strengthening its balance sheet. Both operate in energy but couldn't be more different in risk profile and time horizon. As always, do your own research, consider your financial situation, and never invest more than you can afford to lose. Here's the infographic breakdown. Solid Power, high-risk battery tech with major partnerships. Ring Energy, cash-flowing oil producer. Choose growth or value, or diversify with both under $5. I'm William, and if you found this valuable, smash that like button, subscribe for more deep dives, and I'll see you in the next one. Keep investing smart.